Very good evening to all of you. What Vinodji said, that we have gone into deeper into the subject, and there is a very interesting phrase. It says, "Jo duba so par." Right? So by this time you have already, succeeded. What for you have joined this particular intensive workshop. So I have a very less time with me available to me, and my expertise will be how fast I can click my buttons forward. So quickly we'll take up this issue, and of course in this particular session Vaibhav is going to join me, and he is going to tell all of us how the valuation part of this entire, whether it is FDI or ODI, how that valuation is to be done, and I am going to talk about this pricing guidelines on that aspect. So these two aspects we will be covering. So just for your refreshing your memory, these are the legal provisions which you have to see when you look into this pricing guidelines. These definitions we have already seen. I am not going to talk about foreign investment, foreign direct investment, foreign portfolio. So what I am trying to do is, this is the first part, which is foreign investment. But capital instrument, I think this is one definition which we should devote some time. So this has been defined as equity shares issued in accordance with the provision of Companies Act, and includes equity shares that have been partly paid. Then second is fully, compulsorily, mandatorily convertible debentures, and similarly convertible preference shares, and share warrants which has been issued by an Indian company in accordance with the regulation issued by SEBI. So these four are considered as the capital instrument, and of course there are certain notes which at the moment I am leaving. So let's go one by one and see what are the pricing guidelines with respect to that. So if you look at this, the transaction can be of two types. One is the issue and another is the transfer. So let's first look at the issue part, how when the initially shares are, or the capital instruments are acquired. So there you can see that it can be in the shape of a public issue, it can be right issue, it can be preferential issue also. And in preferential issue, the pricing guidelines has divided that into two parts. One is with regard to frequently traded capital instruments, and the other is infrequently traded, and mostly this is for the listed companies, this thing. And of course the capital instrument issued by unlisted companies. So taking those one by one, in the case of a listed companies, you can see here the main is pricing is that the price of capital instrument issued to a person registered outside India shall not be less than the price worked out in accordance with the relevant SEBI guidelines. So in the case of a listed capital instruments, the primary or the base is the SEBI guidelines. And of course SEBI guidelines, I'm sure the Vaibhav is also going to touch upon those a little bit. But quickly, on the public issue, an issuer may determine the price of specified securities in consultation with lead merchant banker or through the book building process. Book building process is again specified by the SEBI. So these are SEBI guidelines on with regard to issue price. Similarly, issue with regard to right issue, it shall be determined in consultation with designated stock exchange. On frequently traded capital instruments, SEBI guidelines has divided that into two parts. One is where there are where equity shares are listed on request exchange for a period 26 weeks or more on the relevant date. The allotment to be made at a price not less than the higher of the two. So I think this you can see here. So they have given this, and in all other cases, price shall not be less than higher of the following. So what I am trying to say, these are not FEMA guidelines. These are basically, FEMA guidelines simply says that go by the SEBI guidelines, and these are the SEBI guidelines. And with regard to preferential issues in respect of infrequently traded shares, the price determined by the issuer shall take into account valuation parameters, including book value, comparable trading multiples, and such other parameters as customarily those valuation of shares are being considered. But in the case of a unlisted company, because again here SEBI regulations would not be applicable. Now the most important point here is said that the price of capital instrument of an Indian company issued certainly to a person shall not be less than. So now they have given a less than, and here it says that the valuation of shall be done by internationally accepted pricing methodology for valuation on an arm's length basis, duly certified chartered accountant. Mr. Bhutta mentioned about that in spite of the valuation being done, now they want that it should be written there that it is not less than the arm's length price. That is the reason, because in the pricing guidelines it is mentioned that the valuation of instrument has to be internationally accepted pricing methodology for on arm's length basis. So arm's length basis has to be established. That's why whatever valuation comes, along with that there has to be one clause should come that this price is at arm's length basis also. Issue price of convertible capital instrument. Here the main I would say the principle is that in the case of a convertible capital instrument, the price conversion formula has to be determined upfront at the time of issue of instrument itself. That's the main, you cannot leave, and here there can be so many ways to really put that thing in place, that how that determination will happen. There can be a variation in that, and you can see in some of the cases different type of, very unique structure has been used by valuers to satisfy this particular clause. The only criteria is that it should be determined upfront at the time of issue itself. Acquisition through right issue or a bonus issue. Again here a person resident in India and having investment in Indian company may make investment in capital instrument. Here actually if you look at whatever price is being offered to the resident shareholders, that at that price person resident outside India can also acquire those shares. Now coming to the transfer part of it, when those shares are being transferred. So again here once again listed Indian company and unlisted Indian company, and then there can be two situations. In first case, transfer by a resident to a person, a resident outside India, and transfer by a person resident outside India to a resident. Similarly, in the case of a unlisted Indian company, transfer by a resident, same, so in how it is to be done? The price of capital instrument of an Indian company transferred from a person, a resident in India to a person resident in India, shall not be less than the price worked out in accordance with the relevant SEBI guidelines in case of a listed Indian company. So there is the, once again, shall not be less than are important, because it can be more, but it cannot be less than that. See, what I have as a basic FEMA, when I discuss and when I grabbed concepts of FEMA, so I was very clear that what they wanted to convey, RBI want to convey to us, is that whenever you are selling Indian assets to another to an outsider, you should get the best price, and whenever you are selling it again, the Indian should get, because ultimate aim is how to save foreign exchange. At the moment we are not talking about that, but conceptually it is that whatever you are selling you get the best price. So from that point, these type of words shall not be less than. It does not mean that price, it means this is the threshold, lowest price is that, beyond above that it can be anything. Transfer by a person resident outside India to a person resident in India. So you can see this from here, that resident, a non-resident person not resident in India to person not resident in India is not covered, because it has nothing to do with, because in that case foreign investment remains as a foreign investment, so no issue there. But when it is coming from person resident outside India to a person resident in India, it shall not exceed. Na? So you know, see that, what a point I was trying to say. In one case they are saying shall not be less than, here they are saying shall not exceed, so that faltu paisa bahar na chala jaye. That is the idea. The price worked out in accordance with relevant SEBI guidelines in the case of a listed company, and at the price at which preferential allotment of shares can be made under the SEBI guidelines as applicable in case of a listed in company or in case of a company going through a delisting. Now coming to the unlisted companies transfer of shares of capital instrument of a Indian unlisted company. Here again you can see shall not be less than. The valuation of a capital done as per internationally accepted pricing methodology and arm's length. Similarly, that what we have seen in those cases here also. So for the time being, you can see that listed all SEBI and whatever the SEBI guidelines provides. In the case of non-listed, it is internationally accepted pricing methodology that becomes the benchmark. Beyond it should not be less than that. So in the case of a Indian unlisted company, this is the provision. Valuation of capital instrument by a company by a transfer by a person resident outside India. Yeah, I think this we have already seen. Yeah, sorry. Reverse of. Okay, fine. So valuation in case of swap of capital instrument. So in this case, subject to condition that irrespective of the amount, valuation involved in swap arrangement will have to be made by a merchant banker registered with SEBI or an investment banker outside India registered with the appropriate regulatory authority in the host company. Because in this case what is happening, valuation of two securities are being considered. One which is coming to you and one you are issuing. So from that point of view, two valuers are getting involved into this when there is a swap of capital instrument.
So that means here you cannot, the chartered accountant cannot do it.
Yes, in the case of swap. Yeah, absolutely. Share warrants, in the case of share warrant, the pricing in conversion fraud shall be determined upfront. Again, that same logic, that because ultimately share warrants are going to be converted at a later stage into shares. So therefore, the conversion formula has to be determined upfront. Valuation of capital instrument for transfer by a person resident outside India to a resident. This is now in the case of a transfer. The guiding principle would be that the person is not guaranteed any assured exit price. This is a very important point, because most of the time when you look into the joint venture agreements, when they come here and invest, sometime Indian promoters offer them that okay, we will assure that you will get that kind of, and then they, based on that, they make an investment. So but pricing guidelines are very clear that officially you cannot assure them that when you will exit you will get that much money. It has to be based on the valuation as done by in a proper way as we have explained. So the point here is, the guiding principle is that there cannot be any guaranteed or assured exit price at the time of making such investment. So the second part is with regard to overseas investment by a person, a resident in India. So here again you can see the various definitions which I think we have very discussed thoroughly. What is overseas investment, what is financial commitment, and ODI and OPI. Okay, pricing guidelines for shares of a foreign entity. Here again you can see that again here also issue and transfer, both sides has to be looked at. So far as issue is concerned, issue of shares can be in a number of ways. It can be through subscription, when the Indian party is setting up a company there, and by through subscription they are getting themselves into that company. And then issue of shares of an existing company when investment is more than 5 million. This is a distinction here, more than 5 million USD and other cases. And then transfer of shares of a foreign entity by. And the second aspect, which when we come to the transfer part of it, again same, person resident outside India to a person resident in India, person resident in India to person resident in India, person resident to resident, and then resident in India to person resident outside India. These are three different structures which has been given in the pricing guidelines, and acquisition through swap and conversion of ADR and GDR, because that is another way of going for ODI. What the basic pricing guidelines is, so far as ODI is concerned, the issue or transfer of equity capital of a foreign entity from a person resident outside India to a person resident in India, or to a person resident in India who is eligible to make such investment, or from a person resident in India to a person resident outside India, shall be subject to price arrived on arm's length basis. So arm's length, I think that issue was discussed during Mr. Harshal's session. So I am not going to elaborate on that, but that is the important, or I would say the basic guidelines, that it has to be at arm's length basis. How that is to be done, what are the formulas which are going to be adopted for that we can. And in this entire process, the entire powers has been delegated to the AD Bank. So AD Bank these days are looking into the all aspects of how this arm's length basis is being. So therefore, there's a lot of confusion. When you go to a one particular bank, he would demand for some different papers. You go to other bank, they will demand for some, because they also have delegated these powers to consultant, and then they raise points that in this you bring these papers, you prove this. So virtually, as rightly mentioned in that session, arm's length basis is a very, very, I would say, open-ended kind of situation, where we have to really fight with the AD Bank to prove them that this is at arm's length.
So I think we all know what valuation is, and there were a lot of questions which were raised around whether arm's length requirement after fair value, how fair is that requirement? I think that is something which has been troubling everybody's mind. So I think if there is a requirement, the valuer has to certify that the valuation is on arm's length, in addition to it being certified as a fair value. Why I say so is because if I am a majority shareholder, and if I am making an investment in a company, fair value could be 50 rupees. You are making a minority investment for 2% stake. For you, it could be 45 rupees. There has to be discount for lack of control. If I am making investment in a listed entity wherein I am allowed to easily liquidate my investment, it will be very marketable. But if I am buying 40% stock of a listed entity, in spite of being listed, I might apply discount for lack of marketability. So who is the buyer? What is the situation? What kind of stake you are acquiring? I think those kind of factors need to be evaluated for arriving at an arm's length pricing, which is activity beyond fair value. I think requirements by RBI, FEMA, Foreign Exchange Management, Transfer of Issue of Securities and Companies Act, and what is not mentioned here is Income Tax Act. So I think these are the laws which or regulations which one need to look at while working out a valuation. Now valuation report by a chartered accountant is acceptable under FEMA. Under income tax it is acceptable only if it is from a net asset value method perspective. In case of a equity instrument. So we are talking, this first slide is only for equity instrument. By a registered valuer who is a chartered accountant, Companies Act will accept, FEMA will accept. For NAV method if you have used, income tax will also accept. A merchant banker's valuation is not acceptable by Companies Act. It will be accepted by FEMA. It will be accepted by Income Tax Act. Sir ने अभी अपनी presentation में cover करा where ODI involved is more than $5 million. In those cases, valuation report only by a merchant banker works. Even in case of FDI, in exceeding the transaction value of $5 million, bankers are of the view that merchant banker valuation only works. Convertible instruments and other securities except common equity. In this case, under Income Tax Act, all the valuation report works. That means if you are a chartered accountant and you have used income approach for a convertible instrument, it works under Income Tax Act. I think that's the only distinction which I wanted to bring out. Asset approach, earning based approach, market based approach, and some other factors which I mentioned like control premium, minority discount, and some judicial pronouncements like there are contingent liabilities or there are other issues which are in specific relation to that matter which need to be considered. So in case of quoted securities, which are through a recognized stock exchange, the applicable rate will be the transaction value as recorded on the stock exchange. So if I am not doing an off-market transaction, whatever happens through the stock market is the transaction value and it is the fair value and it is at arm's length. It is carried out through other than through a recognized stock exchange. If the valuation day is a trading day, lowest price quoted on any recognized stock exchange on such valuation date is the fair market value. So of course it could have an implication that the lowest price is say 50 rupees. So if you are buying shares as a resident, then you cannot buy it above 50 rupees. If you are selling shares as a non-resident, you cannot sell below 50 rupees. Quoted shares carried out other than through recognized stock exchange, if the valuation date is not a trading day, lowest price will be the price on the immediately preceding trading day. In case of unquoted shares and securities, in case of fresh issuance, you will have to read 56(2)(7)(b along with rule 11UA and DCF method or book value method at the option of the assessee. I think this word is not very correct, at the option of the valuer considering the circumstances of those cases. Prescribed valuer, merchant banker for a DCF, and for book value either of a merchant banker or a chartered accountant. Unquoted securities, any person receiving shares or security in that transaction, applicable is 56(2)(10) in case of a transfer, and the book value method, merchant banker or chartered accountant. In case of a 56(2)(7)(b) read with rule 11UA(1)(c), it can be either merchant banker or chartered accountant. So this is for other than equity shares. I think this is the last concept which I want to take. So there's a lot of, you can say, noise or buzz around angel tax. So what is angel tax? This provision was introduced in 2012 where you are getting money higher than the fair market value, but it has gained certain relevance because there is a change which has recently been brought about. So now the angel tax is applicable even to the investments which are brought by the foreign investors in terms of the recent change in the budget, after which they have now notified certain specific exempt jurisdictions and the nature of investors who are only excluded from the purview of angel tax, while for all others, if you are getting money at higher than the fair value. Why it is very important is because he said that you cannot subscribe shares at a price less than the fair market value. So what if I am subscribing shares at 2x of the fair market value? Then obviously, if I do not have a specified investor, then it will lead to taxation under Income Tax Act in the hands of the investor and the investee company. So I think I'll conclude here. And of course, these are some proposed changes that if a non-resident entity notified by central government provide consideration for company issuance of share, the fair market of value may be determined on the price corresponding to that consideration. However, this consideration should not exceed the aggregate consideration received by the notified entity within 90 days of the issuance. I think this is maximum I could do. Thank you so much.